Hello and welcome to Wescott's latest webinar series. My name is Mark McCarron, Chief Investment Officer. And in today's webinar, we're going to talk a little bit about the global lockdown and how it's impacting the financing of state and local communities. But first, let's run through the agenda. As usual, we're going to talk through a market and economic outlook and update through May 15th. Talk a little bit about the way Wescott's building portfolios today and our outlook going forward, and the impact of the global lockdown on state and local financing is really going to be felt most in the tax-exempt municipal bond market. So we're going to do a little bit of a focus on that. So first, a quick update through May 15th. So the economic data that's coming out today in the last couple of days, particularly reflecting April activity, shows a very dramatic impact of the global lockdown, particularly on the service industries. And this is something that Federal Reserve Chairman Powell mentioned and focused on during his latest update. And he provided a fairly somber outlook and encouraged a lot more support from the government and from the Fed to the US economy. Already, Congress has set aside $2.9 trillion to support households, businesses, healthcare providers, and state and local governments. And it's really the state and local government's focus that we're going to spend some time on today. So on this slide, we're showing an economic update through May 15th, but we're really going to focus on retail spending. And we got news this morning that retail spending fell 16% in April from a month earlier. That is a very significant decline. And what we talk about when we talk about retail spending is restaurants, travel, recreation, and food service. So on the right-hand side, we're showing a graph showing each one of those trends. And the transportation is in the blue, and which shows a pretty stable spending pattern of the US consumer up until recently, of course. March and again in April, a significant decline. We're seeing that decline in the recreation sector. We're seeing that decline in the food service and accommodations sector, which includes hotels as well. And the only sector that's going the other way is something called food and beverage purchase for off-premises consumption, or in other words, takeout and groceries. And consumer spending patterns are critical. Not only do they drive 2/3 of the US GDP, but they also impact consumer sentiment, which ultimately impacts confidence and growth going forward. So we're going to spend a little bit more time looking at these sectors. We selected these sectors because these are the ones that are really reflected in the weakness and the weak part of the global economy and the US economy. Yet, if we look at the S&P 500 and the US stock market, we've updated this chart through today. The US stock market remains relatively stable in the second quarter, rebounding again off of its low back in March 23rd, and is maintaining its rebound so far. We've talked about this in many discussions before, but if we look at the drivers of that growth and that rebound, the tech sector in the S&P 500 represents the largest allocation, and it's been the best performing sector so far this year. And going forward, if we ask analysts to give their estimates on what their earnings per share growth for the technology sector should be versus the rest of the market, they have a 16% higher expected growth rate for technology than they do for the rest of the market, which is historically quite high. And only a rebound in global growth will really change and narrow the gap between the technology sector and the rest of the market. And the rest of the market is really what's being impacted by that consumer spending pattern that we talked about. So let's take a look real quickly at the municipal bond market. So like the stock market, the municipal bond market is not immune to uncertainty. And we have right here a graph that shows the performance of the municipal bond market. That is by the Bloomberg Barclays Index. And we see that it's been a fairly modest return throughout 2018, a pretty strong return in 2019, and then a very dramatic drop off in March and April of this year, until the Federal Reserve and US Congress came in and provided stimulus. And you can see the impact, immediate impact on the municipal bond market and the rebound that we saw there. And this is in fact the same rebound, albeit at a smaller scale, that we saw in the stock market. So what are tax-exempt municipal bonds, real quick? These are bonds issued by state and local governments to support roads, bridges, schools, hospitals, and airports. Effectively, they're loans that investors will make to local governments. And for that loan, they get a tax break on the income generated off those bonds. There are two high-level differences in types of bonds in the municipal bond market. General obligation, which are those backed by the credit and the taxing power of the issuer. And then there are revenue bonds, which are very specific to a project. And it's a very fragmented market. There are over 80,000 issuers and over 1 million securities in this sector, in this market. And it's really important, and Wescott uses active managers in this space to differentiate, to decide how to invest, where to invest, and that is critical in a market as uncertain and as unclear as the one we're living in today. So we wanted to take a little bit of time to focus in on one such manager that Wescott has used for many, many years, Thornburg Investment Management. What they do is they provide an insight and a service in evaluating bonds, primarily short-term municipal bonds, those that mature in the next 3 to 5 years. Their emphasis has always been on very high quality bonds, and they have a very strong credit research team, which is becoming even more important as the stresses on the financing for things like toll roads or even airports and utilities and education, which are all the sectors that they invest in. These are becoming really important to differentiate the winners and the losers. So as we talked about before, the impact of the global lockdown on key sectors is really critical. So the general obligations sector, which represents the largest in the market at 39%. You can see Thornburg here has got a slight underweight to that. That's effectively an underweight to areas of the market or states that they have some concern about, whether it be New Jersey, Pennsylvania, California, Illinois. These areas have significant financial strains and also not strong credit ratings, and they have to be thoughtful about how much they put in those states. But beyond the global or the general obligations, there are a whole bunch of other bonds in the market that Thornburg evaluates and tries to determine quality. And one thing I'd like to highlight is that the hardest hit areas of the market may in fact be in the transportation sector. So transportation includes things like toll roads, but also airports. And they highlight that there's been an 86% decline in domestic travel traffic from 1 year ago. That is a dramatic stoppage of activity in that space. And they also highlight that airports like Orlando, which really serve as Disney World from a tourist standpoint, and also there's quite a lot of corporate events and conventions that occur in Orlando. Those have all stopped. And so the concern that they highlight is that certain airports like Orlando may be under more pressure than airports like Dallas-Fort Worth, which offer a broader hub and more access to different parts of the country rather than just a single destination. And those are the types of things that they're looking at to evaluate quality and evaluate investment opportunities going forward. They also look at the hospitality sector, hotels, convention centers. They have very limited exposure in that space, and they think that that's going to be an area of continued underperformance in this market. Other areas that they focus on, investing in hospitals and healthcare. Clearly, the headline news has all about the funding and support for hospitals. First and foremost, the latest fiscal package from the US has continued to support hospitals. And that's important because the treatment of COVID-19 and other emergencies is critical, but not as profitable as other services. And those other services, of course, have been put on hold. So a credit risk may develop. And as you can see, that Thornburg has about a 9.5% allocation to the healthcare and hospital sector. And it's really credit research is critical in evaluating where to put capital and where to avoid it. And so really the highlight here is that the importance of being thoughtful about how much risk you're taking in the market and where the sector allocation should be in this market is really driven by the outlook for the economy, the outlook for tax revenue, and the outlook for demand picking up ultimately in areas, for example, like Orlando and other tourist attractions around the world. And we think the local impact of the pandemic can be felt by all of us. We can see it around us. We can see restaurants and other recreation activities being put on hold. And I think the summary here is that in March of 2020, the municipal bond investors were really reminded of how quickly conditions can change. As we showed, 2019 was a very good year for municipal bonds, but 2020 has turned into a very difficult year, full of uncertainty. Critical that we have an active manager looking at ways to take advantage of and also protect capital. The Federal Reserve has provided an initial backstop for the municipal bond market, but certain sectors may be impacted for years to come. We talked about the hospitality and the travel sector. Credit research. Beyond simply looking at credit ratings, Thornburg and other active managers that we use in the program have become even more, this feature of what they do has become even more important in these times. And I would like to end to say that Wescott clients through Thornburg and other managers have benefited from an investment approach that's focused on quality. Quality in the bond market in general, quality in the stock market, and also quality in the municipal bond market as well. We've seen Thornburg hold up nicely in these uncertain times, providing stability for clients in Wescott's tax-exempt portfolios. So with that, I wanted to again thank you for joining us and continued trust and confidence in Wescott. We always offer this, but please do not hesitate to reach out to me or your advisor directly with any questions that you might have. Thank you.